Well, I'm of the view that the nominal neutral rate is no higher than 3%. So I'm of the view that the Fed has no business being almost 100 basis points above neutral when you consider the trend in underlying inflation, which has been gradually to the downside, but is on the downside. And
Right.
the unemployment rate, keep in mind, we always talk about how inflation is still above the Fed's target. The Fed has a dual mandate, and the unemployment rate is just a snick now to the second decimal place below 4.5%. And the Fed thinks it's going to be down to 4.4 next year, which I think is going to be a big surprise for them. But their view is that NAIRU, or the full employment unemployment rate, is 4.2%. So we're already above that. And the unemployment rate is trending higher, whether that's due to demand or supply factors, it
Right.
doesn't matter. Slack is being built up in the labor market. They should be at neutral already. I'm of the view that we will be at 3% by late winter and on our way down towards 2 to 2.5 by the end of next
Right.
year.
I want to parse David right now. I got Neil Dutta with a brilliant chart driven article on a staggering America. I've got Mike Green of Simplex out on Substack on a staggering America. I think Paul and I deal with this every day. There's a part of America flat on their back. Does this rate cut help them, or do we need one, two, three, four rate cuts to begin to help an America that's not buying Google chips?
Well, look, there's all sorts of structural or secular problems, related to, let's call it income and wealth inequality, that has undermined the low end. And the low end, of course, is also being undermined by the fact that their purchasing power, has been on a relentless downward trend. Will one rate cut make a difference for the lower income thresholds? Probably by a smidge. Um, I think that they need more in the way of income support that transcends no tax on tips, which is a small section of the labor market, and no tax on overtime. So I think there's some other problems. I think the bottom line, though, Tom, is like what we found out from Walmart just this past week, is that the pressures are not just on the low end, but now seeping into the middle end. And of course, Walmart's grabbing market share because high-end consumers are now parking their Mercedes Benz in the Walmart parking lots. So you're seeing this shift in consumer behavior that's already just transcending just what's happening at the low end of the consumer. That speaks to me of reduced demand pressures, and that should lead to even lower inflation unless somehow we're going to have more supply bottlenecks coming our way. So it just comes down to my view that the Fed is, as you said, I agree, they are behind the curve. The question is by how much. It's good, I think, that you've got some of the heavyweights on the Fed, not just Waller
Yep.
and not just Daly, but you have to say that Williams, being the New York Fed president, is the second most important person on the FOMC. So I think they'll cut in December. To me, the big question mark is going to be how constrained Powell's going to be at the podium, and what those ridiculous dot plots are going to tell us. Because are we going to have the
Go.
situation like last year where they shoot themselves in the foot? The way that you see it comes back to your question, Tom. I mean, the way you stimulate the economy is that you cut rates and you convince the markets there's more coming.
Right.
You don't shoot yourself in the foot
Right.
by saying we're one and done, because the
Right.
consumer base and the business sector is priced off the
Right.
bond curve, not the overnight rate.
Paul, jump in here, but January 28th, I haven't even said this. The second meeting now is January, late
There you
January.
go. Okay. So, David, we're going to get some retail sales here this morning, 8:30 a.m. Wall Street time. How do you think the U.S. consumer's doing?
Not so well, and I'm actually surprised that the consensus is so strong on the headline and the core control. We know that auto sales were down almost 7% month over month, and we also know that chain store sales are pretty weak. But then again, this is pretty lag data. I'd say that the consumer picture, to me, is on the soft side. It's only not contracting, because of the equity wealth effect on spending at the high end. I know you guys have been all on top of the bifurcation in the economy, the K-shaped economy. What if I told you that since April, real consumer spending is up at over a 2% annual rate, but that real disposable income is running negative 1% over that period? We have this dichotomy between real incomes after tax and real spending. And of course, the fallout from that is the fact that the savings rate is falling like a hot knife through butter, much like it did during the dot-com boom, when everybody believed that our bloated 401k plans are going to look after us in retirement, so we'll spend all of our after-tax income. So much is riding on the stock market when it comes to the economy. But again, a small slice of that, because the top 10% own 90% of the stock market. That's what's keeping the glue together. But people don't see that we might not have a recession in consumer spending.
Yep.
But we do have a recession in real household incomes. That started in April. Doesn't get enough attention.
How about, I guess that brings us back to consumer confidence, and most people have a job. I mean, if you just look at the headline unemployment rate, how do you think about the underlying labor market here?
Well, I mean, look, in the worst recessions, when, say, the unemployment rate would get to, like, let's say it goes to 10%, you'd say the same thing to me. You'd say 90% of the labor force is employed. What's there to be worried about? 10% unemployment rate, we'd be in almost a depression.
Yep.
So it's not the level. It's not the level of the unemployment rate that matters. It's the change.
Okay.
It wasn't that long ago at the cycle lows, we were 3.5%. Now we're pressing at 4.5%, and the trend is going up. So it's not the level of the unemployment rate. By the way, I would tell you that if you looked at the historical record, look back at the past 11 recessions back to 1950, most of them started with the unemployment rate exactly where it is today.
Yeah.
So don't be lulled by the level, the 4.44% level. Don't be lulled by the level. Focus on where it's going.
Right.
And the level is a head fake, besides the fact that it's a classic lagging indicator. So to be looking at the unemployment rate to formulate your views on where the economy is going to be going in the next 12 months is like looking in the rearview mirror.
Got to leave it there, David. Next time, much longer visit, please. David Rosenberg, Rosenberg Research, Toronto there, getting out front of not only messaging a rate cut, but messaging further rate cuts to come is being the key idea.